Welcome to the Deep Dive. Have you ever looked at a company's financial report and just, found yourself scratching your head?
Oh, definitely.
Maybe their sales just skyrocketed, but somehow they actually made less money.
Right, that paradox.
Or their cash balance just sat there, flat, while other numbers on the sheet went absolutely wild. It's often like a financial detective story.
Mm-hmm. You have to look beyond the obvious clues.
Exactly. And today, we're putting on our detective hats. We're diving deep into the latest financial results of Semilase Corporation. They're a pretty interesting player in the LED chip and component market.
Yeah, they are.
And this deep dive, it's really designed to help you quickly get a handle on the most important insights from their latest report. We want to cut through the jargon, get straight to what matters.
Good plan.
So our source material, it's directly from Semilase Q3 2025 financial results press release. It covers the quarter ending May 31st, 2025, and we're comparing it back to the previous quarter, Q2. And our mission, it's to go beyond just those surface numbers, untangle the complex shifts, and really understand what these financial movements mean for the company, maybe its future.
Okay, let's unpack this.
It's quite the puzzle, isn't it? Because on the surface, SemiLD's reported what looks like, a spectacular top-line success story this quarter.
Absolutely, and that's exactly where we need to start digging. For the third quarter of fiscal 2025, SemiLDs saw its revenue surge. We're talking $17.7 million.
Yeah, a big number.
It's a huge jump from $10.9 million in the prior quarter. I mean, that's an increase of nearly 63%. So from that angle, you'd expect a really fantastic quarter, right?
That kind of revenue growth is definitely what companies aim for, no question.
Yeah.
But like you said, while the sales figures look impressive, the deeper you dig, the more nuances pop up.
Yeah.
That kind of surge, it immediately makes me ask, was this growth sustainable? And maybe more importantly, was it actually profitable growth? And this is exactly where our financial puzzle starts to get really interesting. It reveals this paradox that might surprise a lot of people listening. Because despite that huge revenue jump, SemiLD's profitability metrics actually went down. Their GAAP gross margin, that's their official profit margin, using standard accounting rules for Q3 2025, it plummeted to just 5%.
Wow, only 5%.
Yeah, and that's way down from 9% in Q2.
Yeah.
So they sold a lot more stuff, but the profit they actually made on each sale got really squeezed, severely squeezed.
Yeah, a declining gross margin like that, especially when revenue is surging, often implies that the cost of the goods they sold, it grew much faster than the revenue did. And the numbers back this up. Their cost of revenues jumped dramatically, over 70% quarter over quarter.
70%.
Yeah, so that explains the paradox you mentioned. Even though they brought in way more revenue, their actual gross profit in dollars went down slightly. It fell just under $1 million in Q3 compared to just over $1 million in Q2. And when that happens, it's not just, a number thing. It signals a real strategic issue. Are they pricing super aggressively to grab market share, even if it hurts immediate profit?
Could be.
Or is it something deeper, like production issues, maybe higher raw material costs?
Yep.
Or perhaps they were just trying to clear out older, lower margin inventory, especially given their product mix, general lighting, versus those specialized UV things.
Right. That puts a totally different perspective on that big revenue number. And it wasn't just the gross margin acting weirdly. Their operating margin also took a big swing. It went from a positive 1% in Q2 to a negative 0.4% in Q3.
Oof. Negative territory.
So what does a negative operating margin like that signal about the company's core business operations?
Well, it tells us that in Q3, the company actually had an operating loss of about $62,000. And that's compared to making $110,000 in operating income back in Q2.
Okay, so a loss from operations.
Exactly. And when your operating margin turns negative, that's usually a pretty significant red flag. It basically means the company's main business activities, making and selling its LED chips and components, they weren't generating enough profit to cover all the day-to-day operating costs.
Gotcha.
That includes the cost of goods sold, which we talked about, but also things like R&D spending and their selling, general, and administrative costs, the SG&A.
And did those costs go up too?
They did, yeah. Both R&D and SG&A expenses saw increases this quarter, and that definitely contributed to pushing them into that overall operating loss.
So let's connect these dots for everyone listening. What was the final impact on the bottom line for shareholders? We've got more sales, clearly, but a real struggle to turn those sales into actual profit. The GAAP net income for Semilase stockholders, it dropped to $223,000. That's about 0.03 per diluted share in Q3. And that's down from 388,000 or 0.05 per share in Q2. It really highlights that profitability squeeze we're talking about, even with the revenue boom.
Precisely. The story here isn't just about sales volume. It's about the efficiency and the profitability of those sales. But, the financial picture is never really complete just by looking at the income statement.
Right.
To really get the full picture of Semiali's financial health, we need to flip over to the balance sheet. That's often where you see the real story of how a company is managing its assets and liabilities, and especially its cash.
Okay, yeah. Let's dig into the balance sheet then. Interestingly, their cash and cash equivalents stayed remarkably stable, pretty much held steady around $2.4 million in both quarters.
That is interesting, given the other numbers.
Yeah, the specific figures were about $2.44 million at the end of Q3 versus $2.38 million in Q2. Pretty close. But here's where the balance sheet gets really intriguing, especially down the liabilities section.
Okay.
It kind of raises a big question. If the cash stayed flat despite all the revenue growth and profit challenges, where did the money flow in other areas? Because there were some really dramatic shifts happening there.
Indeed. That cash stability, when revenue is up but profits are down, it forces you to look really closely at their working capital management.
Right.
And the most striking moves were definitely within their current liabilities. You saw this massive, massive increase in accounts payable. It just rocketed from only $445,000 at the end of Q2 to an astonishing $10.8 million at the end of Q3.
Wow. $445K to nearly $11 million. That's huge. What does that imply?
It's a giant increase in what they owe to their suppliers. Simple as that. But here's the twist, and it's crucial. Conversely, their accrued expenses and other current liabilities saw an equally sharp decrease.
Oh, okay.
They plummeted from over $15 million down to about $4.1 million.
So one huge liability went way up, another went way down.
Exactly. And what's fascinating is how these two massive movements pretty much balanced each other out. Their total current liabilities only saw a slight decrease overall. It went from about $17.9 million in Q2 down to roughly $17.5 million in Q3.
Huh. So the total didn't change much.
Right. This balancing act, basically delaying payments to suppliers by letting accounts payable balloon while simultaneously clearing out other short-term debts, it's a pretty common tactic for companies trying to manage tight cash flow.
Okay.
It lets them keep their cash balance looking stable by essentially using supplier credit as a kind of informal short-term loan. But it also raises questions, right? Potential strain on supplier relationships down the road, or future payment obligations if profitability doesn't bounce back quickly.
That definitely paints a clearer picture of what's happening behind the scenes. Explains how the cash stayed steady. We also saw a noticeable drop in inventories. They went from over $13.5 million down to around $11.9 million. Given the revenue surge, that could suggest they sold a lot of existing stock, maybe they're moving products efficiently, or perhaps it reflects better inventory management, less stuff sitting around.
Could be either, or a bit of both. And looking just quickly at the equity side, Semiality stockholders' equity actually ticked up slightly from about $3.6 million to nearly $4 million.
Okay, a positive move there.
Yeah, and their accumulated deficit, which is essentially the sum of all their past losses over time, saw a small reduction. Still negative overall, but moving slightly in the right direction. So a small but, notable positive sign for long-term financial health.
Okay. Before we wrap up this deep dive, let's just quickly remind listeners about Semiality's core business. What do they actually do? They're a developer and manufacturer of LED chips and components.
That's right. And their product applications are actually quite diverse, which, can definitely impact their financials in ways like we've seen. They cater to general lighting, think street lights, commercial, industrial, home lighting.
The common stuff.
Yeah, the high volume stuff. But they also have a pretty big presence in specialized industrial applications. Things like ultraviolet or UV, curing, medical and cosmetic devices, counterfeit detection, even lights for growing plants, architectural lighting, entertainment lighting.
So quite a range.
A very wide range. They produce blue, white, green, and UV LED chips. And the nature of that business, having both high volume general stuff and these more niche specialized markets, it often means they face really fluctuating demand cycles and pretty intense pricing pressures, especially on those more commodity-like LED chips.
Right.
This quarter's results could just be a prime example of that whole portfolio strategy playing out, maybe with some unexpected profitability hits in the short term.
Okay, so let's recap our deep dive into Semiality's Q3 2025 financials. The big picture. The company saw really impressive revenue growth, no doubt about
It's
that.
huge growth.
But that top-line surge came with some significant struggles on the profitability side. We saw that clearly in the declining gross and operating margins and the drop in net income.
The squeeze was real.
And at the same time, we saw these really significant shifts on their balance sheet, particularly that dramatic jump in accounts payable being offset by a sharp drop in accrued liabilities, which suggests some pretty active and maybe complex financial management going on to keep that cash position stable, despite the profit challenges.
Yeah, this deep dive really shows you the hidden story behind the numbers, doesn't it?
It really does.
It just highlights that a company's financial health, it's never just about one single number, like revenue or net income. It's really about how all the different pieces, the income statement, the balance sheet, cash flow, how they all interact and tell a more complete and often, frankly, surprising story about a company's strategy and its operational realities.
That's a great point.
So as you look at financial reports, always try to consider how changes in one area might be affecting or, being affected by shifts somewhere else that seem unrelated at first glance. There's almost always more to uncover when you start connecting those dots.